Hello everyone, welcome back to our weekly webinar series. My name is Faiza Hashmi. I am the tax director here at Crest Cooper. Today I have been joined by my colleague Mahar Afzal, who is the managing partner, and together we will take you through today's topic. The topic for today is intellectual property and what is the potential of intellectual property to attract the 0% corporate tax rate and the benefit it can that it can take in the free zones. So now, if you have missed any of our previous lectures or you want to revisit some of our previous lectures, they are available on our YouTube channel. Our handle is Crest Cooper. And if you have any questions, you are free to email us at info@crestcooper.com and we will be happy to respond to that. Now, moving on to the topic of today, let's discuss what is intellectual property first. So now intellectual property refers to intangible assets. Intangible assets are those that do not have a physical form, that are owned and officially registered in the person's name, mean they are legally protected under the law. So this means that no other person can use these intangible assets without the consent of the person who has registered them under the law. That's why they're legally protected. Some of the examples of intellectual properties are like patents, copyrights, copyrighted software, trademarks, formulas, brands, technical know-how. These are all types of intangible assets that are intellectual property. So now, under the corporate tax law, these intangible assets, this intellectual property can further be characterized. We can characterize it as qualifying intellectual property asset or non-qualifying intellectual property asset. So the treatment for both, or you can say that non-qualifying intellectual property asset cannot enjoy the 0% tax rate, and some portion of the qualifying intellectual property asset enjoys the 0% tax rate, which we will discuss in the coming slides. Now, let's discuss first what is a qualifying intellectual property under the corporate tax law. So, under the corporate tax law, they have said that qualifying intellectual property refers to patents. So, those patents that have been given under UAE law, or if they have been granted under any foreign jurisdiction under a similar law, any copyrighted software that's included in qualifying intellectual property. So, those also that are granted under either UAE laws, copyright laws, or either they're granted in a foreign jurisdiction but in a relevant similar law. Then any rights which basically are equivalent to a patent, so means that they should be legally protected, they should be subject to similar approval and registration process the same as a patent. And examples of that we can take is like utility models or intellectual property assets that grant protection to plants and genetic materials, so like breeders rights, so that allow or grant some exclusive control over some new varieties of plants, you can say, or orphan drug designations which are granted by the government agencies for any pharmaceutical drugs that is used to cure rare diseases, extensions of patent protection. So there are examples of that. What qualifying intellectual property under the corporate tax law does not include is any marketing related intellectual property assets. So the example we can take is like trademarks. Now, qualifying fee zone person might be involved in research and development of the intellectual property asset. So now there's a possibility for them to either they can earn qualifying income. So like we said, that certain portion of the qualifying income, certain portion of the qualifying intellectual property can earn qualifying income and attract the 0% corporate tax, whichever is meeting the criteria. This criteria we will discuss later in the slides. Now, any non-qualifying income from the qualifying intellectual property, that person that's not meeting the criteria, and any income from the non-qualifying intellectual property assets, both of them, they will be subject to 9% tax rate. And that income which is being subjected to the 9%, which is the portion which did not qualify from the qualifying intellectual property, and that from the non-qualifying intellectual property, both those income, they then will not be considered for the de-minimus calculation as well, because straight 9% is being applied to them. Now, a qualifying fee zone person can generate a qualifying income from a qualifying intellectual property asset. Now, if there is a direct link between the income that is generated from the qualifying intellectual property asset and the eligible R&D expenses, the research and development expenses that have contributed to that income. So there needs to be a nexus between the two, between the income generated from the qualifying intellectual property and the R&D expenses. Now, qualifying income will only arise to the extent that the qualifying fee zone person has either incurred the R&D expenses themselves, or that has contributed to this qualifying intellectual property, or either they have outsourced this to another person. So now that the qualifying income can be generated if it is outsourced to any other party. So it can be a third party, it can be a related party, but only if you are outsourcing to related party, which is situated outside of the UAE. So then any income generated through that, to that portion, that would not be part of the qualifying income. So that would be a non-qualifying income. Let's take an example. Now, company G is a free zone person. It is deriving income in a tax period of, let's say, 200,000 from the qualifying intellectual property and 100,000 from other intellectual property. So we know that the other intellectual property that would not be part of the qualifying intellectual property. It's a non-qualifying intellectual property. So that would attract the 9% corporate tax rate. From the 200,000, which is a qualifying intellectual property, like we discussed, that if the criteria is being met, there's a formula that is provided in Article for one of the ministerial decision 265, if they're meeting that, which we will be discussing in detail in the later in the slide. So that portion is what will qualify. So for example, under that formula, 60,000 is what comes up. So from the 200,000, this 60,000 portion is what the qualifying income is being, arising from this portion. This is the qualifying income which will attract the 0% corporate tax rate. But any income exceeding this, so let's say from the 200,000, the remaining 140,000, that will attract the 9%. So now the 140,000, which is in excess of the 60,000 from the qualifying intellectual property, and also the 100,000, which was from the non-qualifying intellectual property, both of them will attract the 9% corporate tax rate. And like we had discussed in our previous slides, that if the related revenue will also then not be applied or will not be taken into consideration when we are doing the de minimis calculation as well. So now I will hand it over to Mahar, who will take you through the rest of the presentation.
Hello, everyone. Thank you very much for joining us once again. And Faiza, thank you very much. So whatever we're discussing today, as Faiza mentioned, that we're discussing impact of corporate tax on the intellectual properties in the UAE. And she has already briefed what is the intellectual property. And intellectual property means any intangible assets which are legally registered in the name of the person, that is the intellectual property. It can be patent, copyright, all these. It can be trademark, it can be any software as well. So these are any technical know-how, we can say any customer list, all these are the intellectual property which are already registered in the name of the person, that is called intellectual property. Now it can be classified as a qualifying intellectual property, it can be classified as a non-qualifying intellectual property. What is qualifying intellectual property? Basically what they said, if this intellectual property asset is registered in your name and this asset is not being used for business purposes, then this is called qualifying intellectual property. If this asset is being used for the business purposes, then this is not called a qualifying intellectual property. Like I just wanted to give you an example, like Crest Cooper. Crest Cooper is a trademark. We are using the Crest Cooper for business purposes. We are marketing Crest Cooper. This is a trademark. This trademark is being used for business purposes. So it will not be considered as a qualifying intellectual property, but at the same time, if we have any customer list, any patent, that from that patent from the customer list or any trademark, sorry, any other intellectual property asset from which we are generating separately identifiable revenue, then definitely it will be considered as a qualifying intellectual property. Now, if we are discussing on overall basis, what is the corporate tax treatment of the qualifying intellectual property in the UAE, we can classify the businesses into two types of categories. It can be a non-qualifying free zone persons or qualifying free zone person. There no difference for the non-qualifying free zone person. For the non-qualifying free zone person, we need to assess either the person who is holding the intellectual property and who is generating the income from the intellectual property. That person is a resident taxable person, or that person is a non-resident taxable person. We know who are the resident taxable person. Resident taxable person means all businesses which are incorporated in the UAE. These are called the resident taxable persons. At the same time, any business who is registered out of the UAE anywhere across the globe, but that business has been controlled and managed from the UAE, this is called resident juridical persons as well. For these for this juridical persons which are incorporated in the UAE, or the juridical persons which are incorporated out of the UAE, but these are being controlled and managed from the UAE, we know this, their worldwide income is subject to tax. So if these businesses are holding any intellectual property asset, and from that intellectual property asset they are generating separately identifiable revenue, then for that revenue will be mapped into the taxable revenue. And if their taxable income up to 375%, 0% corporate tax will be applicable. Beyond that 375,000, it will be tax will be 9%. I'm assuming the business income, I'm assuming the revenue of this business is more than 3 million dirham, and they have not opted for the small business relief. We all know this. If they have opted for the small business relief, there no corporate tax applicable to them up to 31st December in 2026. 0% corporate tax will be applicable, but at the end they will not be liable to pay anything to the government. So the resident taxable person can be natural person as well. As we know, this natural person, and these are the, and we know this, if this is a natural person, any worldwide income related to business in UAE, that income will be subject to tax in the UAE. We know this up to 1 million dirham annual revenue. If the natural person has 1 million dirham annual revenue, they will not be subject to corporate tax. They will be exempt from the corporate tax. If the revenue is more than 1 million, then up to 375, 0% corporate tax is applicable, and beyond that 9% tax is applicable. The natural person can opt for the small business relief as well. The non-resident taxable person, it can be PE of the non-resident person in the UAE, then income attributable to the PE will be subject to tax in the UAE. The rest of the all rule are same like a juridical person. Then if this is a non-resident person who is UAE sourced income, then the UAE source income will be subject to tax, and 0% withholding tax will be applicable for the time being. Non-resident person having an intellectual property, they cannot have a nexus in the UAE, because nexus provisions are only applicable when there is the immovable property held by the non-resident person. So this is the provision for the intellectual property for the non-qualifying free zone person. Means it will be treated like a normal business. They are generating income. We need to check their status. They're the juridical person, they're the natural person, they're the resident juridical person, they're the non-resident taxable person. Either they have opted for the small business leave, either they have not opted for the small business leave. If they have opted, then they will not subject to corporate tax by the end of 31st December 2026. Natural person, all this. What I'm trying to say basically, if this is a non-qualifying free zone person, and non-qualifying free zone person is generating any income from the intellectual property asset, this income can be separately identifiable income. Then we need to map that accounting income into the taxable income. That taxable income up to 375,000, 0% corporate tax, beyond that 9% target tax. We need to look into the provisions of the small business relief. We need to look into the provision, the status of the person as well, either resident, non-resident, natural, juridical person. All the normal provisions of the law will be applicable. Now coming up to the qualifying free zone person. For the qualifying free zone person, special provisions have been given in the law. Special provisions have been given to the free zone businesses if the businesses are involved in the research and development of the intellectual property asset. Law has given them special privilege. While given a special privilege, they said the asset must be a qualifying intellectual property. If these provisions are not applicable for the non-qualifying intellectual property, what is qualifying intellectual property? My colleague, Ms. Faiza, she has already told you qualifying intellectual property means intellectual property asset which are registered as per the intellectual property laws applicable in the UAE or any other laws across the globe related to the intellectual property. First thing, and these assets are not being used for business purposes, then it will be considered a qualifying intellectual property. Anything other than this, it will be considered a non-qualifying intellectual property. If this is the non-qualifying intellectual property and the person is a qualifying free zone person, law is very specific. Law says any income generated from the non-qualifying intellectual property, this income will be straightforward subject to tax at 9%, and this income will not be considered to apply the de minimis criteria. This is the first thing. Second thing, coming back to the qualifying intellectual property. Now the qualifying intellectual property, there is a possibility that this qualifying intellectual property research and development is being done by the qualifying free zone person. And this research and development, if the qualifying free zone person is doing the research and development, and if the qualifying free zone person is generating any income from that intellectual property, proportionate income or the full income, it all depends. We'll look at example as well. So that portion of the income that directly related to the research and development, that portion of the income will be considered research and development in the UAE by the qualifying free zone person. That portion will be considered qualifying income. If the qualifying free zone person has outsourced this research and development to any other party in the UAE or any other party out of the UAE which is not your related party, I'm repeating, might be there is a possibility research and development is being done by the qualifying free zone person, or the qualifying free zone person has outsourced the research and development. Once they have outsourced the research and development, there is a possibility that the research and development has been outsourced within the UAE, or it has been outsourced out of the UAE to a non-related party or related party. If this research and development is being conducted in the UAE, either by the qualifying free zone person, either by any other party, which is related party, which is non-related party, any other third party in the UAE, then the law says income attributable related to the research and development that is being conducted in the UAE, that portion of the income will be considered my qualifying income. Now, if the research and development has been outsourced out of the UAE, and the portion of the income that relates to the research and development related to the intellectual property asset that has been outsourced to a non-related party, that portion will be considered my qualifying income. If this research and development has been outsourced out of the UAE to a related party, that portion will be considered my non-qualifying income. It will be straightforward subject to tax at 9%. The same thing I have mentioned here as well. You can go through this. Say the qualifying intellectual property, R&D is in the UAE or R&D is out of the UAE. If the R&D is in the UAE, might be this is in-house R&D in the by the qualifying free zone person, or this is R&D to any other party in the UAE. Then in this way, both of the cases will generate a qualifying income. In both of the cases, this income will be considered for the de minimis calculation as well. Now this R&D is being conducted, it has been outsourced out of the UAE. If this R&D, research and development to develop the intellectual property asset from which the qualifying free zone person is generating separately identifiable revenue, then this R&D of the intellectual property asset has been outsourced to non-related party out of the UAE. If this has been outsourced to any other party which is not a related party out of the UAE, then it will generate qualifying income. It will be considered for the de minimis test as well. But if this research and development has been outsourced to a related party out of the UAE, then it will be considered non-qualifying income, and this income will be straightforward subject to tax at 9%, and this income will not be considered to apply the de minimis test. I believe everyone is very clear. So this income, and this income, these two incomes are non-qualifying income for the qualifying free zone person, and rest of the all income for the qualifying free zone persons. So this income, of the qualifying free zone person and this income of the qualifying free zone person, it will be straightforward subject to tax at 9%. It will not be considered for to apply the de minimis test. This income of the qualifying free zone person it will be straightforward subject to tax at 0%. It will be considered for the de minimis test. One important thing is there, which is not mentioned in the guide. If the qualifying free zone person is not conducting any research and development, and if the qualifying free zone person is buying any intellectual property, getting it registered in its own name, then selling in the market, generating separately identifiable revenue, so will it be subject to tax at 9% or 0%? I believe it will be straightforward subject to tax at 9%, because if I am going to the essence of the guide, essence of the law behind this, because this privilege has been given to the qualifying free zone person if they are conducting research and development. If the qualifying free zone person is not conducting any research and development, so they don't have any right to take 0%, they don't have any right to enjoy the 0% corporate tax on the qualifying income, qualifying intellectual property. Because if you are going into the formula, if you are going to the nominator of the formula that we will be discussing in our coming slide, the nominator of the formula is the qualifying expenditures. Whenever you are buying the intellectual property, I believe you are the expenses that you are incurring, those expenses are not the qualifying expenditure. We look at the definition of the qualifying expenditures as well. So third possibility can be there. So this property is not being developed by the qualifying free zone person. They are just buying and selling, generating income. That income will be straightforward subject to tax at 9% instead of 0%. And what is the reason for this? The reason is the research and development has not been conducted by the qualifying free zone person, because this all exemption that is being provided to the qualifying free zone person, it all depends upon the research and development conducted by the qualifying free zone person. No research and development, no qualifying income. 100% research and development by the qualifying free zone person, 100% revenue will be considered qualifying income. So this will look into the coming slides, we'll look at the formula as well. So I believe everyone is very clear for the qualifying free zone person. What is the qualifying income related to the intellectual property, and what is the non-qualifying income related to the intellectual property? Let's move to the next slides. So this is the formula. This formula, so we decided, we have in the previous slide, we have decided the intellectual property can be qualifying intellectual property, it can be non-qualifying intellectual property as well. So some portion of the income of the qualifying intellectual property will generate the qualifying income, and some portion of the income, it is a possibility, some portion of the income is not a qualifying income. It all depends upon this formula. They said, what is the formula to calculate the qualifying income of the qualifying intellectual property? Just keep in mind, they're asking qualifying income of the qualifying intellectual property, qualifying income of the qualifying intellectual property. Non-qualifying intellectual property, straightforward subject to tax at 9%. So qualifying income of the qualifying intellectual property is equal to qualifying expenditures. So non-qualifying expenditure will not be part of this formula. This qualifying expenditure means research and development. We'll look into the next slides. So qualifying expenditure plus uplift expenditure divided by overall expenditure. In this overall expenditures, non-qualifying expenditures will be part of the overall expenditures as well. Then we need to multiply the overall income generated from the qualifying intellectual property. So basically the logic is, how much you have spent on the research and development divided by the total expenditure on that qualifying intellectual property, multiply the income generated from the intellectual property. So it all depends. The game is basically, important thing is how much you are spending on the research and development. If we are going into qualifying expenditure, they said to support the research and incurred to support the research and development activities conducted either by the qualifying free zone person or outsourced to a third party in the UAE abroad who is not a related party. So if I'm going to the previous slide, sorry. So the expenditures incurred by the qualifying free zone person, this leg they are asking, expenditure incurred on this leg, expenditure incurred on this leg, and expenditure incurred on this leg. So these three expenditure will be research and development expenditure incurred 1, 2, and 3. These three expenditure will be considered your qualifying expenditure. You need to uplift it by 30%, but whenever you are uplifting, it should not go more than the total expenditure on the qualifying intellectual property. So 1, 2, and 3, these are my qualifying expenditure. You can go through a definition as well. Incurred to support the research and development conducted either by the qualifying free zone person or outsourced to a third party in the UAE or outsourced abroad who is not a related party. It will be considered your qualifying expenditure. This is the reason that I was saying, if you are buying any property and selling in the market, it means you are qualifying expenditure is zero. When the nominator is zero, whatever is the denominator, it doesn't matter. Your qualifying income will be zero. Basically the catch is how much you are spending on the research and development on the qualifying intellectual property asset. So qualifying intellectual property here, as I mentioned, qualifying expenditures, amount spent on research and development in the UAE or out of the UAE to a non-related party plus uplift. This uplift can be maximum 30%, but this plus this 30%, this total should not be more than overall expenditure. Then we need to multiply the overall income generated by the qualifying intellectual property. Whatever my resultant, it will be my qualifying income. Remaining will be straightforward, subject to tax at 9%. I believe everyone is clear regarding this. The formula requires the overall numbers over the life of the qualifying intellectual property. These numbers, expenditures, uplift will be straightforward 30%. Overall expenditure, overall income. These are the as a number starting from the beginning of the asset. So qualifying expenditure we have already discussed. Overall expenditure means qualifying expenditure plus non-qualifying expenditure related to the qualifying intellectual property. So qualifying expenditure plus acquisition cost. If you have, it is the same thing I'm repeating. Acquisition cost. If you have spent anything on the acquisition, it will not be considered your qualifying expenditures. Then outsourcing to a party, which is your related party out of the VA. If you are adding these two things into the overall qualifying expenditure, they will give it to you. It will give it to you overall expenditures. And the amount spent on the creation, inventions, significant development, the qualifying intellectual property asset. So we know overall expenditure, we know qualifying expenditure. The difference between the qualifying expenditure and the overall expenditure is acquisition cost or outsourcing for the research and development to any party which is your related party out of the UAE. Uplift expenditure, it should be maximum 30%, but the qualifying expenditure plus the expenditure, it should not be more than the overall expenditure, the ceiling as well. Overall income means separately identifiable income generated from the qualifying intellectual property asset. So these are the four terms that were used in this formula. Qualifying expenditures, we know this. Research and development in the UAE, research and development out of the UAE to a non-related party. Plus uplift expenditure 30%. Qualifying expenditure plus uplift expenditure should not be more than the overall expenditure. Overall expenditure is equal to qualifying expenditure plus acquisition cost plus outsourcing to a related party out of the UAE. Overall income means overall income generated from the qualifying intellectual property asset. So this is how we can calculate the qualifying income. Rest of the remaining whole income will be straightforward subject to tax at 9%. Now, if the qualifying income, if one person is developing, a qualifying free zone person is developing one intellectual property in-house, and they can identify the income as well. So nominator will be 100 plus 30%. Denominator will be 100, maximum 130 into overall expenditure. The whole income will be considered qualifying income. They're generating one asset only. But if they're generating multiple assets, we'll look into this. How can they track the expenses? How they bifurcate the expenses? How can allocate the expenses on pro rata basis? The expenditure to be linked, this is the important thing again. That they are asking expenditure. Now the expenses you are in qualifying free zone person, there is a possibility the qualifying free zone person, they are developing only one asset. So the cost related to that as a research and development, allocation, development, invention, creation, everything, this cost can be categorized into two categories. The first cost can be directly traceable cost. Like one person is specifically working on the research and development of product A, intellectual property asset A, another is working on B, another is working on C. Three persons are working on three different intellectual property asset, mean we can directly trace the cost. Now the admin cost. Now the admin cost, it will be office rent is there, building is there, so it will be common cost. This common cost will be allocated directly. This common cost will be proportionately allocated to the intellectual property asset. So some will be traceable costs, some will be common costs. Traceable costs will be directly allocated. Common costs will be allocated on proportionate basis. Then we will be able to know how much is the expenditures qualifying expenditures of the respective qualifying intellectual property asset. So they are given the example, basically, asset like research and development personnel salary. We'll go to the guide, we'll discuss in the guide as well. Then the expenses, admin expenses will be allocated. Qualifying expenses should be recognized when incurred. This is the important thing. They are asking, it doesn't matter whatever the tax treatment, it doesn't matter whatever the accounting treatment. Whenever you are incurring the expenses for the research and development or any directly traceable or common expenses, you need to know when these expenses are being incurred, and it needs to be considered into the formula on as on basis. We should not look into the accounting treatment, we should not look into the tax treatment. And moreover, whenever these activities, the research and development, are being outsourced to any party in the UAE or to any party out of the UAE, so the criteria for the allocation of the expenses will remain same. Directly traceable, common expenses needs to be allocated. The formula necessitates the inclusion of qualifying expenditure, overall expenditure, and overall income. Yes, we have already discussed. Whenever you are going to consider the overall expenditures, income, qualifying expenditure, you need to track the expenses as well. You need to apportion the expenses, track the expenses. There should be a proper tracking system. Law is very clear, guide is very clear. They are asking, if you don't have the tracking system, you will not be able to enjoy the 0% relief. You must track the all expenses. You must have the evidence of all expenses. This tracking can be on product basis and overall nature of expenses basis. This tracking can be on intellectual property asset basis, or it based upon the project where these assets are being utilized or to whom the assets are being delivered. The multiple methods can be there. Important thing is you need to track your expenses. You need to have a record of your expenses. If you are not tracking your expenses, you don't have the record of your expenses, you will not be able to enjoy the 0% corporate tax or qualifying income of the qualifying intellectual property. There will not be any qualifying income if you are not proper tracking. It is clearly written in the guide. They can require to track all figure. Tracking is easier to qualify as single asset. Single asset is quite easy. Whatever the revenue is generated from the single asset, whatever you have spent on the research and development, you can give it to the FTA. They will be satisfied. You can claim, okay, 100% income generated from the qualifying intellectual property. It will be considered your qualifying income. But if you have multiple assets, like under the same building, you are developing 5, 10 qualifying intellectual property assets. These are being used in different products. Then tracking is very important. You need to track and you need to trace all those expenses. The next is approach checking qualifying expenditure and overall expenditure of QAP asset drive qualifying from asset well before the corporate. There is a possibility. They are given basically the transitional rules in the guide as well. They are asking, might be because the development of the intellectual property asset, it takes time. They are asking if you are developing the intellectual property asset, they are asking, they believe you will not be tracing and tracking the expenses before the implementation of the corporate law, because there was no requirement to trace the expenses. But if you are developing an intellectual property asset and you are not tracing this, for the first 3 years, you can take on overall basis the share of allocation. They are asking overall expenditure, overall qualifying expenditures, overall total expenditure. You need to multiply with the qualifying income, and you need to multiply with the total income, total revenue generated from qualifying intellectual property. That portion will be considered your qualifying income. They are asking, if you don't have the record, total qualifying expenditure, not product based. They are asking overall basis. Then they are asking overall expenditure. Then you need to multiply with the overall income. This formula you can use for the first 3 years after the implementation of the law to claim the 0% tax on the qualifying income that was being basically developed before the introduction of the corporate tax law. In this, you need to consider the overall basis. Total qualifying expenditure divided by overall expenditures. You need to multiply with the overall income, you will get the percentage. You are not required to split on product by product basis. But they are asking after the end of 3 years, then you need to apply the same formula on product and product basis. They said, qualifying for reason person derive qualifying income from such asset developed before the corporate tax law, but needs to track historic expenditure. Definitely you will not be doing. They are given Transitional ratio method based on the 3 years rolling average on overall basis is permitted initially, shifting to cumulative ratio later for the fourth and subsequent tax period on individual product basis. We'll look into the example as well. Then we ask you to establish the connection qualifying expenditure. You need to maintain the record. This will be ownership record, expenditure record, income record. Along with this, you need to mention relationship between the expenditure, income, and all these things. They're asking expenditure for general R&D linked to specific asset explained. We need to maintain the record. If we are buying anything from the related body, it should be in the arm length principle without proper tracking. If you are not tracking, usually there will be 0% benefit. There will not be any income, basically qualifying income. Still, you will be 0% benefit, but this income will not be considered to apply the de minimis test. So this is basically example. We can go through the guide quickly. Then I think once we are going through the guide, we'll be able to we'll be in a better position to go through the applications. Okay. Okay, this is a guide, basically guide for the intellectual property. In the general, there nothing is basically, I'll say, nothing is there that we were not already discussed. If you are with this in the general, we have discussed everything. Important thing is highlighted here. If the qualifying free-zone person acquires qualifying intellectual property or outsources the R&D to a related party outside the UAE, the portion of the income that is attributable to the acquisition cost or outsourced R&D doesn't give rise to the qualifying income, and this income will be straightforward subject to tax at 9%. Then they're asking intellectual property. We have discussed. They are asking ownership and exploitation of the intellectual property. In this, the treatment that income generated from the ownership and exploitation this is basically outsourcing R&D in the UAE and out of the UAE that we already discussed. Intellectual property, they have defined refer to the intellectual property owned and legally protected by the person, but it doesn't include the marketing related property like trademark that we have already discussed. This example, Faiza has already discussed this example. I think you have already gone through this. Income must be derived from the intellectual property. Then income from the intellectual property, it should be separately identifiable income that is being generated from the qualifying intellectual property. That income will be considered to apply the formula to ascertain the qualifying income. Like company H develops intellectual property and licenses and develops it to its customer in exchange for a royalty. This royalty is identifiable. Royalty income is directly attributable to licensed intellectual property, would be treated as the income derived from the ownership and exploitation of the intellectual property. Qualifying intellectual property, if you're going into the definition of the qualifying intellectual property, they're asking qualifying intellectual property includes all this basically. Patents, copyrighted softwares are right functionally patent that has been registered as per the intellectual property laws applicable into the UAE or any relevant laws of the foreign jurisdiction, but this property is not being used for marketing related purposes, that will be considered my qualifying intellectual property. This is the formula that we have already discussed. Qualifying of the qualifying intellectual property is equal to qualifying expenditure plus uplift expenditure divided by overall expenditure into overall income, that we have already discussed in detail. This cost, basically R&D cost, they classified their directly traceable costs, salaries and wages, direct costs, overhead costs. Some costs will not be linked with the qualifying intellectual property, like interest payment, nothing to do with the intellectual property, building costs, acquisition costs, any other cost directly linked to not directly linked to specific qualifying intellectual property are not included in the qualifying expenditure. We have already discussed. Building costs and common costs will be shared on a prorated basis, that we have already discussed as well. R&D expenses outsourced a person, the UAE person outside the UAE, that is not a related party. We have already discussed this. Qualifying expenditure, we have already discussed this. Overall expenditures, we have already discussed. If you go into the overall expenditure, means outsourced to any person. These are not, it doesn't matter. The related party, out of the related party, all expenditure will be considered in the overall expenditure. So it will be equal to qualifying expenditure plus acquisition cost or plus outsourcing to a related party out of the UAE. Overall income that we've already discussed. Uplift expenditure we have already discussed, but it should not be more than 30%, and overall it should not be more than overall expenditure. If you're going into the example 39, there's incurred qualifying expenditure of 100, qualifying expenditure 100, admin cost 10, and paid 40 for the R&D expenditure to a related party out. So this 100 is my qualifying expenditure, 10 plus 40, 150 is total my overall expenditure. If my uplifting 100 by 30%, 130 is less than 150, so I can uplift it 130 is fine. In the second example, their uplift expenditure, incurred qualifying expenditure of 100, acquisition cost 5, paid 20 for the R&D expenditure to a related party outside the UAE. So my qualifying expenditure is 100. My total expenditures are 125. I cannot uplift up to 130 because this is going more than 125, which is my overall expenditure. So I can uplift maximum up to 125. 100 plus 25, 125, because this law says the uplift expenditure plus the qualifying expenditure should not be more than the overall expenditure. In another example, qualifying company K incur qualifying expenditure of 30,000 and overall expenditure of 100,000. Qualifying 30,000, overall 100,000. Okay. Company K has an overall income of 400,000. So 30,000 multiply 1.3, it will become 40. So how much it will become? 30 plus 30%, it will become 39 divided by 100,000, multiply 400,000, you will get the qualifying income. Tracking system wants to, this is what we discussed. We need to ascertain the overall expenditure. We need to assess the qualifying expenditure. We need to assess the qualifying overall income as well. Once we are liable to do, then we need to track everything. We need to basically keep record of each and every expenses. We need to keep record of income. We need to keep record of overall expenditure, qualifying expenditure. Then there's given the method. They are asking product method. Like company L produces plastic lids for the travel mugs. Company L has 2 patents, one of which applies to plastic lids for coffee mugs and one of which applies to plastic lids for the tea mugs. The R&D responsible for the 2 patents was undertaken by 2 different teams. So 2 different products are there, 2 different teams are there. I think it can be very easily traced. They said company need to track and trace the qualifying intellectual property asset. It will need to set up a tracking system that tracks income for coffee mugs and tea mugs separately, because R&D was separately, team was separately, expenses were separately. We need to track the income separately as well. Then ask on tracking product for families, unrealistic. You can go through this. I just wanted to give you an example. If you're going into this, they are asking, there is a possibility that expenses are being incurred on family basis, expenses are being incurred on product basis, expenses are being incurred on individual item basis. If the expenses are on individual item basis, or the expenses are on family basis, or the expenses are on product basis that is being traced, then we need to trace the income exactly on their basis as well. Otherwise, it will be very difficult if we are incurring the expenses on overall. Suppose one company generating 100 product, they are incurring all expenses on overall basis, they are not tracking the expenses for individual item, then it will be very difficult how much income has been generated by each product. On the vice versa, if the expenses are being tracked on the individual item wise, but revenue we are not tracking, we are assessing overall revenue, then it will be very difficult to assess how much revenue has been generated by each individual item. If you're going through these examples, they are asking multiple components. The tracking was based upon the multi-company set up a tracking system to track and trace on component basis. Because expenses was being tracked on component basis, income needs to be tracked on component basis as well, apple to apple comparison. And they are asking various types of hinges. They include various types of hinges that are built for the specific trucks. If now R&D and expenses are hinges basis, the revenue should be on hinges basis as well. Or on the vice versa, if the revenue are hinges basis, we need to trace back the expenses on hinges basis as well. Tracking system for qualifying intellectual property categories. You can go, they are asking 100 different types of printers, multiple printers. Then employee track their research and time according to which the product family. Now there are three families, and these three families, they're asking if your research and development on family basis, company would need to track and trace the product families and would need to set a tracking system. Expenses are being tracked on family basis. Income should be tracked on the respective family basis as well. Apple to apple comparison. Again here, there are thousands of patents on which product hundreds of pharmaceutical products. Thousands of patents of which produces hundreds of pharmaceutical products, but 4 different diseases that is product treat. Now they're asking this research and development is being undertaken on diseases basis. 4 different diseases. Then they have been given the company P, therefore need to track the income on diseases basis as well. So it doesn't matter you have 1,000 product, 1,000 patents, 100 products, but your R&D is on disease basis. The income should be traced on disease basis as well to ascertain the qualifying income. Now they're asking overall expenditure before that we already discussed in the slide, that if there are overall expenditures and these expenditures are incurred before the introduction of the corporate tax law, they're asking for the first 3 years, you can go on overall basis, then you need to ascertain it on product to product basis. The tax period following the introduction of the rule apply to a ratio where the qualifying expenditure overall, they're asking where the qualifying expenditure and overall expenditure are calculated based on 3 years rolling average. After this, they need to ascertain, and these are the example. In this example, they're asking before 2023, nothing will be considered. Only expenses related income, whatever it will be considered from 2022, 22, 23, 23, 24. After the end of 24, once they will enter in 25, they need to have a tracking based on the individual item. The first 3 years, 22, 23, 24, on overall qualifying expenditure, overall qualifying income. Then after this, second year, overall expenditure, overall income. Third year, overall expenditure, overall income. Fourth year, individual product based tracking. So you can say here, in 2024, they are asking overall 10,000 divided by 18,000. 10,000 is the qualifying expenditure for the first 3 years, 18,000 is the overall expenditure. Qualifying expenditure, 10,000, 5,000, 8,000, 10,000. This is my overall qualifying expenditure for the first 3 years. Then this is qualifying expenditure. Overall expenditure, 10,000, 13,000, 18,000. So this for 2024, 10,000 divided by 18,000, you need to multiply with the overall income and you will be getting a qualifying income. For the next year, you will not be considering this year. You will be considering next 3 year rolling basis. These 3 years. These 3 year qualifying expenditure, 2,000, 4,000, for the next year, you will be considering, you will not be considering 2022. You will be considering 23, 24, 25 on rolling basis. Sorry. These 3 years you will be considering. So 3,000, 2,000, 5,000, 2,000, 7,000. 7,000 is my qualifying expenditure on overall basis for 23, 24, and 25. This is 7,000. This is 7,000. Then overall expenditure 3,000, 8,000, 11,000. So 7,000 divided by 11,000, you need to multiply with the overall income, you will be getting your qualifying income. Now in 2026, so first year gone, second gone, third year 24 gone, 5 gone, 6. On the 6, sorry, 3 years have gone. Now you need to have a tracing on individual product basis. If you go there, they are asking product A, product B. How much is the qualifying expense? Because you have a record of the past 3 years for the individual product. Now you need to trace in an individual product. Individual product tracking is 4, 5, and 6. So 4, 400, 1700, 17,800, 2,500. 2,500 divided by overall expenditures of product A. Overall expenditures are 2,400 plus 2,000, 4,400, 4,400 plus 800, 4,400 plus 800, 5,200. This is 5,200. In the same way, you can apply for the product B as well. So basically, if you have any expenditure before the introduction of the law, for the first 3 years, you can take in an overall basis. For first 3 years on rolling basis. After 3 years, you need to trace it on individual product wise proper tracking system. So for the first 3 years, even you will not incur the expenses after the introduction of the law, still you will be able to enjoy the qualifying income of the expenditure that were incurred before the introduction of the law, but the revenue generated after the introduction of the law. A record needs to be maintained. You need to maintain a proper record. And important thing is asking, if you are not tracking it, you will not be able to. It's a very important line. It was here somewhere. Yeah. If the qualifying freezing person doesn't have an adequate tracking system, it will be unable to demonstrate the amount of qualifying income arising from its qualifying intellectual property assets. In this case, qualifying freezing person won't be able to apply the 0% corporate tax income of the qualifying intellectual property. No tracking, no relief. This is the bottom line. But still they are asking, if still you are not getting relief, then this income will not be considered to apply the de-minimus test. Even the qualifying freezing person would still be able to exclude this revenue from the ownership and exploitation of the intellectual property from total revenue and non-qualifying revenue while applying the de-minimus test. This is over from my side. Thank you very much. And if you have any question, you are most welcome. Would you please help us understand the R&D expenses would be allowed expenses in each case? I already discussed R&D expenses are directly linked with the revenue. Zero R&D expenses, zero qualifying income. 100% R&D expenses, 100% revenue will be considered qualifying income. 50% R&D, 50% revenue will be considered as a qualifying income. Basically, it all depends upon the formula, but everything is triggered, everything is linked. This is a direct link, basically, R&D and qualifying income. R&D percentage, we need to consider. R&D means qualifying expenditure. Qualifying expenditure divided by total expenditure. This percentage needs to be multiplied with the overall income. That income will be considered your qualifying income. Rest of the income will be considered non-qualifying income. If you have any further question, you are most welcome. No more question? Oh, guys, thank you very much and have a lovely evening. Thank you and nice to speak to you.
Thank you, everyone.
Thank you very much, Faiza. Take care. Thank you.